Hi, everyone. My name is Isabel Martin, and I am the marketing manager for Princeton Mortgage's Affinity Program. I might have met a few of you or spoken with a few of you before, and those who I have not had the opportunity to meet yet. It's great to see you, and I just want to thank you all for being here. We're really grateful for all of our affinity programs, and we're just excited for y'all to be a part of what we're doing at Princeton Mortgage, and have really enjoyed helping some of you with your mortgages in the past, and really look forward to getting to know some new faces and helping you out in the future. I'd like to introduce and turn it over to our dedicated affinity loan originator who's here with us today, Brett Shapiro. Brett brings a wealth of industry knowledge and is really excited to share more about refinancing today. And just in terms of any questions, we'll go through a brief presentation, but if you have any specific questions, feel free to type it in the Q&A box and we can stop and answer those as we go. All right.
One quick little thing before we turn it over to Brett. Just want to, while we're all together, want to congratulate Brett. He was actually just awarded a top 1% loan originator. It's called the Scotsman Guide Award out of all loan originators across the country. So it's a huge honor. We're so grateful to have him on our team, and just know that every one of you guys, you're a part of our affinity program, and you will be in the very best of hands with Brett. So wanted to give him a quick little shout out before we get underway. But Brett, take it away.
Thank you, Courtney. Thank you, Isabel. That's a lot to live up to, but I do appreciate the confidence boost. Friends of Princeton Mortgage, Affinity Partners, welcome to this webinar. We did post it for 90 minutes, but we think in reality, it'll be more along the lines of 30 minutes. And we want to make sure that all of your questions are answered as well. So the theme of this is don't wait to refinance. And basically, the reason why we're doing this webinar now is because after seeing what were historical lows in interest rates in January and February, all of 2020, but really January and February of 2021, rates have come up here in March. And based on everything we're seeing with the new president, inflation, where rates are headed is probably north. So we have a period of time where they're kind of constant right now, and they're in a great spot. So we want to bring the message, don't wait to refinance. You are still going to get a rock bottom interest rate with a great closing costs from us. And if you wait any longer or you missed out last year, you might miss the bubble. So the purpose of this webinar is to show you what kind of options you have refinancing, and for you to make sure that you share with yourself, your family, and your friends. Don't wait to refinance if you're still waiting. Thank you. This is me. We're going to pass this deck out. So you have my email, you have my number, you have how you should apply, any way to contact me directly. I am going to be your dedicated loan specialist. You will not have to go through any prompts to get a hold of me, any switchboard. You will have my direct cell phone number, my direct email, and your direct portal to apply. And I will be your dedicated loan specialist, and I'm going to be glad to help you each out individually. So what are the benefits of the Princeton Affinity Program, and what does that all mean to you? Our Affinity Program wants to give you guys an effortless experience in terms of getting the loan done, as well as giving you guys the best pricing without having to shop with 10 different vendors. You guys don't want your credit run 10 different times. Coming to us, we're guaranteeing we're going to give you the best pricing and that we're going to give you the best quality of service without you having to go look anywhere else. So the first big bullet point is that we're going to give you $1,750 off your closing costs. What does that really mean? The average closing costs are between $3,000 and $3,500, depending upon your state, depending upon the size of your loan. So $1,750 off your closing costs means we're basically going to cover half of your costs for you. That's incredible, because the entire reason of why you should want to refinance is, and does it make sense, is how quickly will I recoup my costs? But we'll talk about that down the road. Secondly, you have one-on-one access to a dedicated loan advisor. If you want to ask me 100 different scenarios, I will put 100 different scenarios together for you. You have our access to our online mortgage portal 24/7. Where you apply is going to be where you put your initial application, all your documents, any communications that require a safe portal. You're going to have access to that portal 24/7 via a login and password that is created for you. And lastly, you'll receive our attempt at an effortless mortgage experience, which we back with our famous Princeton promise, which is that if you are unhappy for any real reason with our service, we will give you $1,000 back at closing, no strings attached. So if you think that I've dropped the ball, or the processor has dropped the ball, or an underwriter or a closer has dropped the ball, then we will give you $1,000 back extra at closing, because we want to make sure that we are striving to do our best. And the only way to do that is to get feedback from you. If that feedback is great, awesome. If it's not, we want to pay you for it and thank you for your loan. We are the only company to do this, and we have been challenged that it's not a great idea. And I don't have a ton of time to go into it, but the reality is, of us doing this over the last 2.5 years, less than 1% of 1% actually claim the Princeton promise. But we're a big feedback company. Our CEO is driven heavily on problems and feedback, and we would love to hear if anything throughout the whole process isn't effortless at all. So what is refinancing? It's simply paying off your existing loan and replacing it with a new one. There are a lot of reasons why you would want to refinance. The first would be to obtain a lower rate. The second and more popular one right now is to shorten the term of your mortgage, which would also include getting a lower rate. The third one would be potentially converting from an adjustable rate mortgage to a fixed rate mortgage. And lastly, to tap into your equity. While this huge seller's market is upon us right now, where we're seeing there being very little inventory on the market, people overpaying for houses. The good news there is your house value is also going up every time somebody overpays for a house in your neighborhood. Your house value just went up 5-10%. So potentially tapping into that equity, for various things: college education, home improvements, cash out for education. Those are the big ones we see. Cool. Everyone asks me the famous question the first time we get on the phone, and I love it. And it makes me laugh, but I love it. People go, what is the rate? Okay. I'm glad to share that with you. We're a very transparent company. I'm a transparent person. I can definitely give you a range of rates that we could supply to you without us pulling your credit. But let me at least show you why either myself or someone else that you have worked with has asked you for a full application prior to giving to you a rate. These 4 things: income, equity, assets, and credit, all drastically change how your rate is calculated for you. No two people have the exact same rate or the same formula. So income, we look at what is your debt ratio. Very simply, what is your total gross income versus what are the debts on your credit report, monthly payments, divide them out. In general, they need to be under a certain number. The lower that number is, the better your approval is going to be. Equity. And by the way, income, we can lend up to 50%. Just to give you guys some kind of idea, 50% is the debt ratio that we can go up to. Equity. The person that has 10% equity in their home and is asking for me for a loan at 90% loan to value versus someone that has 50% equity in their home, you're going to get 2 different programs. The person with more equity in their house is going to get a better rate. Assets. The more money you have in the bank, the better rate you're going to get. Potentially the better income you're going to get as well if we're doing an asset depletion loan. And credit. Your credit score matters. We lend down to 600. The best score you can get is an 850. There's a 250-point delta in which, when we look at applicants, you could potentially get a better rate. If you're an 800 credit borrower or close to it, you're going to get a better rate than someone that's a 630. All of those things go into it. So the credit score ranges, to just shoot back one second, Isabel, just wanted to kind of recap because this slide to me is important and there's not a lot written on it, but these 4 bullet points, which I appreciate you doing. Credit ranges of 600 to 850 is what's approvable. Equity, I can do a loan on a refinance up to 97% of the value of your house. So you really only need to have 3% equity in your house to do a refi. And income, we need to be under the 50% mark. If you're able to do those things, then you're going to get a loan. The better you stand in each of those categories, the better loan you're going to get. Thank you, Isabel. Now you can push it. Mortgage rates over 10 years. This is an interesting chart. What's really interesting, though, is what's really happened over the last month. But basically, over the last 10 years, if you look at the 30-year fixed, which is in blue, we were basically around the 5% mark in September of 2011. We also reached that height back in 2018. And the box is there, so it's a little hard to see, but we were as low as about 2.75 on a 30-year fixed a couple months ago. Right now, we're still in the high 2s, low 3s, which is why I'm telling everyone that that'll listen. If you're interested in refining or at least looking at your options, now is the time before it takes its next jump. Unless you refied within the last 12 months, you probably don't have a rate that is under 4%. You may, so it's worth it. It's worth it. If we can get you a rate that's in the high 2s or the low 3s on a 30-year fixed and you want to save money monthly, it's worth it. If you're someone that is thinking, well, you know what, I'm doing well at my job. I've got some equity in my house. Maybe let's look at a 15-year. I want to pay it off faster. Then we're looking at a rate that's going to be in the mid 2s. If you're looking at a cash out loan to pay off some debt, there are some hits for cash out, but you're still looking at a rate in the low 3s, and it's still in a great spot right now, which is why getting the message out. Don't necessarily listen to the news and the media that rates are on a rise. Yeah, they are, but they're still in historically low spaces. Thank you, Isabel. Okay. Refinancing to secure a lower interest rate. One of the best reasons to refinance is to lower the interest rate on your existing loan. Rule of thumb is that refinancing is a good idea if you can reduce the amount of interest paid by 10 to 15%. A lot of people ask me, and we provided an example here. If a borrower has a 30-year fixed rate mortgage with an interest rate of 4.25% on a $275,000 home, they can lower their monthly payment by $230 by refinancing to 3.125. This scenario we provided here is something that I see every single day. Somebody is in the high 3s, the low 4s. They want to refinance to the high 2s, the low 3s. What are you going to save? It all depends on what is the size of your mortgage. But on average, our average loan size is $275. That's why we use that. You're going to save $200 to $300 a month. It's absolutely worth it. My rule of thumb is more along the lines of how fast you recoup your costs. There's a slide here later, but the real way to determine whether it makes sense to refinance or not is how fast am I recouping my costs? If I'm doing a refinance that's saving $200, but it's got $umpteen-thousand worth of costs on it, it's not worth it. But if I'm doing a loan where I'm getting my costs back in less than 3 years, then the actuarial scientists have said that it is worth it. And for you guys, as part of your affinity, in a hypothetical situation here, if this was you with that $1,750 credit, you'd be saving $230 a month with only $2,000 worth of costs or less on your loan. You're gonna have made it up in 8 months. So we're setting up the benefit for you guys through your employer so that no matter how we structure the loan, it's going to make sense for you. We're not going to be saddling you with with a ton of closing costs to get things done. It will always make sense, whether we're looking at a rate and term loan, a cash out loan, a 15-year or 30-year, for you to do this, because you're going to make your costs up immediately, and you're going to start seeing that savings of that lower rate right away. Thank you. Another good scenario here is someone looking to shorten their term. We're providing you an example here on a $250,000 loan size. The average person who bought a home 3 years ago would save $150,000 by refinancing into a 15-year today. It's $150,000 that someone would save on a $250,000 loan. It's almost like a free investment property for somebody. If you're good with your money and you're reasonably conservative of how you save and spend, then you would want to figure out a way to spend a couple $100 more a month to afford your 15-year, so that you could save $150,000. It's just a lot of money. When I got into this industry, rates were at the 8 and 9% level, and it was like the delta between a 30-year and a 15-year was thousands of dollars. Now it's down to hundreds. So the savvy person right now is finding out a way, man, if I can get an interest rate in the twos, I can save $150,000 cash for just a couple $100 more a month. I might want to think about doing it. So that's something, if you guys call me, I'm going to bring up. Now, look, if you can't afford it, you can't afford it. But I'm going to bring it up, because if there's a way to afford it, we should look at it. Thank you. Refinancing to convert to an adjustable rate or fixed rate mortgage. This is what I'm going to say about adjustable rate mortgages right now. In the past, there used to be a 2% difference between a fixed rate mortgage and an adjustable rate mortgage, where it made sense to take an adjustable rate mortgage. Now there doesn't exist anymore. The adjustable rate mortgages, if better at all, are only better by tiny percentage points. A couple of weeks ago, when I was looking, the 5-1 arms and the 7-1 arms were actually worse than the 30-year fix. You would not be looking into an adjustable rate mortgage right now. What you would be doing is, however, looking to get out of an adjustable rate mortgage. If you're still in an adjustable rate mortgage, unless you are 100% planning on selling that house before the adjustment period comes, I would suggest looking into refinancing into a fixed rate mortgage. You might even be able to get a lower rate right now with a fixed rate mortgage than what you have on your arm. So if you're calling me, let's talk about that and see what options we have, because you don't want to get stuck when the rates go like this. You know, when those adjustment periods come, the arms adjust upward. There's no stopping them. And if you don't have the equity to get out of them, then you're kind of stuck. So let's evaluate if it makes sense. Certainly getting into a new arm doesn't, because there's no real savings over a fixed, but potentially getting out of an arm, if you're in one, we could take a look at that. Thank you. Refinancing to tap equity or to consolidate debt. Homeowners often access the equity in their homes to cover major expenses, such as the cost of home remodeling or education. These homeowners may justify the refinancing by the fact that remodeling adds value to the home, that the interest rate on the mortgage loan is less than the rate on money borrowed from another source, or that the interest rate on the mortgage is tax deductible. Look, I would say to anybody this: if you have a major project coming up, whether it's a vacation you're looking to take, education, home improvements, obviously credit card, that's the easy one. Any major credit card debt, it makes sense to use your house. I get this question all the time. Does it really make sense to put it into the mortgage? Yes, it's debt that you owe. You can't get rid of it. It may as well be mortgage debt, even though it says Chase credit card or Bank of America, Visa. It's your debt. It's not going away. All of these programs that are out there that say that they'll help you reduce that debt drastically hurt your credit. I don't care what they tell you. There's going to be a period of time where your credit is drastically hurt through these other kind of debt minimization programs. If you have the equity, the best thing you could do is tap that equity, pay off your credit card debt, pay off your car if it's a high interest car, whatever you can, and then take advantage of the fact that your rate on your house is 2 or 3%. It's fantastic. There's no reason not to do it. I'm an advocate of it. In fact, one of the things that I like to show people is if you have equity, do a combination of paying off the credit card debt, student loan, etc., and then shorten the term because you're already eliminating the payments of the credit card debt, potentially a car, potentially student loan. Why not use that money that you would be spending and then pay your mortgage down on a 10 or a 15 year? So you might be able to kill even two birds with one stone, which is use the equity you have to pay off the unwanted debt and then take your mortgage and make it a 15 year instead of a 30 year. And you may find yourself still saving money on top of that. So those are the things that we're going to talk about when you guys apply either online or you call me on the phone. Rate and term refinances. These are basically loans where we're not going to be touching the equity of the house. We're just simply going to be putting you into another 30 year saving money monthly, potentially putting you into a 20 year saving money monthly and shortening your term, or putting you into a 15 year and having your payments go up a little bit and you paying off your house. So that's typically the type of refinance that we're doing right now. But with home values going up, we're starting to see a lot more cash out refis coming down the pipe. Cool. Bring us to the cash out. I think you're going to hear a lot about this. A lot of people refied last year. 3/4 of the potential population that could have refied did. That still leaves 1/4 of the potential population, which actually translates into millions of people. But what I think you're going to hear a lot, you're going to see a lot, is when you see advertisements on TV or any radio, is the cash out refinances. This is going to become the new plug, I think, in 2021 and 2022. You're going to hear a lot about it. And I think that everyone should be considering it, especially with the rates in the high 2s and the low 3s. You're just, whether you're talking about credit card debt at 20%, student loan debt at 8%, car loans at 6 to 10% debt, you tapping the equity in your house is going to be the next best thing, especially if it's equity that you've earned over the last 2 years due to this housing bubble that we're dealing with right now, where there's just not a lot of inventory out there. There's 20 bids on every house. Houses are going from 5 to 10% for more than what they should. I think everyone's going to see that bump in their house, and I think that's going to result in a lot more cash out transactions. So that's something you should think about. I'm going to challenge you on it. When you call me, we're going to go online. We're going to get a value estimate of where you're at, what you owe, and if there's any potential to save money, I'm at least going to challenge you guys on it because I want to make sure that you get the right loan for you. Thank you. So 2 types of mortgages. On the left-hand side, we have cash out, extracting equity, paying for home improvements, paying for other high interest debts. That's going to be the theme of what you're going to be hearing over the next year or two. And then on the right-hand side, we have changing your term, shortening the loan, lengthening the loan. You're also going to hear a lot about people trying to get out of their FHA loans into conventional loans. One of the things that we haven't talked about on here that's on this slide, I'll take 30 seconds to talk about it. If you bought your home with an FHA loan, that mortgage insurance is there for the life of the loan. FHA made some changes a few years back where instead of it being on there for 5 years or 78% equity level, they just put it on there for the whole life of the loan. So the only way to get rid of that is to refinance out into a conventional loan. So a lot of you guys that have called, we've done that. We've taken you out of your FHA loan. We've put you into a conventional loan. If you don't have the full equity to get out, we have either bought the mortgage insurance out or at least put you in a reduced conventional insurance to save money. So the goal there is if you guys bought within the last, 5 years and you have an FHA loan, we should be looking at refinancing you, putting you into conventional, getting you out of the mortgage insurance, either because you have the equity now, and if you don't, buying it out, pretending like you have the equity so that it's gone for the life of the loan. That's another big thing that I think we're going to see over the next year or two is everybody that bought FHA just trying to get out of it into a normal conventional loan without that heavy mortgage insurance monthly. Thank you. just kind of recap here. What our role is here in terms of this affinity program through your employer is to provide you with pricing that makes you not want to shop. So that $1,750 credit, which based on our marketing, thanks to Courtney and Isabel, who you heard from earlier, have determined that that's at the top of the mark as to what's being offered anywhere else or above what's being offered anywhere else. So we know that we're being super competitive and making sure that you have the least amount of cost possible. So you're going to get that. Having access to me 24/7. I answer my telephone. If I don't, my message says I'll call you back within 1 hour. That's the dedication that we're at to servicing you guys. And you're going to have a web portal that is set up that you can access 24/7 to check in on your loan, review documents, upload documents, do whatever you want, so that it's your loan, and you'll be able to have access to it 24/7. Then this is me. We're going to give you this deck so that you have access to my email, my phone number. I would love it if you guys applied through your actual employer's link. That way it comes through and it lets me know where you guys are applying from. But if you don't have it or you don't want to do that, that's fine. You can apply through my link. It goes to the same spot. It just doesn't tell me where you're calling from. So you'll have to tell me when I call you. But just there's the websites. You can call me on the phone. You can apply first. You can call first. You can email just to say hi, to talk about scenarios. Whatever you want to do, the goal is to make it effortless from start to finish. And so far, I believe the feedback has been pretty positive across the board. We've been running our affinity programs for a little over a year now. Overall, the feedback has been pretty positive. Courtney and Isabel have done a great job orchestrating it. It's just my job to do the getting you across the finish line. I am licensed in 25 states. So, there's a solid chance that I'm licensed in your state. We've gone through that through your employers to put what states that we cover, but I'm licensed in 25 states. So is the company. And I'm really excited to, do this. This is our first webinar that, I've taken a part of and am doing here. And I'm really excited to meet you guys. And we open this up for a little bit of a Q&A if there is any. I'd love to answer any questions that you guys have. I'd love to meet you guys. And more importantly, I'd like to get you guys saving money the right way. The goal is that you're not going to a mortgage company like you do a deli counter line, pulling a slip that says 117 and you're waiting to hear 116 so you're next. The goal is to treat you, I don't know how to say it, like you were my brother, you were my sister, to give you that same kind of level of service. I love mortgages. I hope it comes through that I have a passion for mortgages. I will spend hours talking to you about your loan or the things you want to know about your loan. I will customize it however you want. I hope you give us the opportunity to do so.
Hey, Brett.
Yes.
We have a couple questions that came in
great.
that I'd love for you to answer. The first one is from Mike. We actually have two from Mike. Is this limited to primary residence?
It's not. It's not limited to primary residences. We do offer this on second homes and investment properties as well. I will say this. Thank you for asking that question. Fannie Mae recently came out and said that they're going to be limiting the amount of second homes and investment properties that they're going to purchase. So this would be for a different webinar, but I will touch on this. In my opinion, there is uncertainty about where the investment property and second home market is going to go. So if you are looking to either refinance or purchase a second home or investment property, I would do so before you can't. Right now, they announced that they're going to be limiting what they purchase to 7% of the total market share to be investment properties and second homes. They've kind of raised the prices recently on doing investment properties and second homes We right now, Princeton Mortgage, are in the middle. We are still doing these. Then we've kind of adjusted pricing to where it should be in the market, but we are still doing them. There was probably a good portion of companies that I saw when I was reviewing this with the secondary marketing manager that have come out and said, we're not doing it. We don't want any more. We're afraid of where Fannie and Freddie are going to be with this. But right now, Princeton Mortgage is still full steam ahead. Primary residences, as well as investment properties and second homes. Cool.
But it sounds like, as you were saying, do them now before you can't.
That's a big concern. I mean, you're in those meetings as well, and all I can suggest is do it now while the rates are low and while you still can.
Yep. Another good question from Mike.
Sure.
Did you? Sorry, I think I accidentally got muted. What was the peak in the early 80s for interest rates?
Oh, goodness gracious, 20%. I mean, we saw rates as high as 20%. Absolutely. And I just saw Mike's question pop through on the range of rates.
Awesome.
Which that's a great question, Mike. So we got to customize it, right? So if you wanted a loan with no points, you're probably looking at an interest rate, in the 4s. If you're looking for something with points, you're probably looking at an interest rate in the 3s. So what I would do is, like, let's just say you emailed me, hey, Brett, could you just give me an idea? Here's my loan amount. Here's my credit score. Could you just tell me what the options are for all different levels of pricing on investment properties? What I would do, come back to you with, is say, sure, based on your credit score and your level of equity, here would be a rate with no points, 1 point, 2 point, 3 points. That way you as the consumer can decide, what's most comfortable for you. Cool. Did any other questions come through, or do we want to open it up to people, or?
I don't see any that came through on the chat.
You wrote, thank you. That was very nice.
Oh, I do see that Jason has his hand up. Jason, you can go ahead.
Yeah, thank you, Isabel. I don't have a question, but more a comment. Brett, appreciate your knowledge and enthusiasm for mortgages. I'm probably someone who will never spend an hour with you talking about mortgages. Sorry. But I would say this on behalf of our organization, which is a new Affinity partner to Princeton Mortgage, that you've helped several of my colleagues already get refinance their mortgages, and all of them have been really, really pleased, not only with your knowledge and obviously good rates, I think helps make people happy, but your level of service and attention. So I know you were sharing some of that with this group, but I can maybe just as an independent voice say that we've seen the evidence of that, and there's a lot of just value to the service you've provided to our system. So I know there's a couple folks from our organization on this call, maybe wondering if this is the right time for them. You certainly have my endorsement on behalf of Soccer Shots. So thank you.
Oh, Jason, thank you. I'll slip you that 20 later, but no, I really appreciate that. And I know you guys are kind of brand new with us, and I appreciate it. You guys have been great so far, and thank you very much. Appreciate that a lot.
Thanks, Jason.
Yeah, thank you, Jason.
Anyone else? Any other questions?
Hey, this is Albert Skirbo. Quick question for you. I'm in Pennsylvania, I guess close to Princeton there. What's the cutoff for jumbo mortgages? And then on a ARM, what is a traditional spread over the index that you're seeing?
So just to clarify, you're in Pennsylvania, not New Jersey, correct?
That's right. I'm right on the border in Yardley.
Okay. So then your cutoff is $548,250.
Okay.
And then once you go over that, you're in jumbo territory.
Okay. Well,
which we do service.
Yeah.
We have two jumbo investors, US Bank and North Point, who we sell our jumbo loans to.
Okay. Well, fortunately, I was in jumbo land, but now I'm below that, so that's good news.
That is good news.
And then what is the spread? Because I currently I'm in 1 year of a 10-year ARM. And I'm just curious of what is the spread over the index that you're seeing, if I went into some product like that.
So the margin on top of the index, it's going to depend if it's a 3, 5, or 7-year ARM, would be anywhere from a low of 2 to a high of 2.5.
Okay, I'm actually in a 10-year product, and with 2 1/4. So I didn't know why
that sounds about right.
Okay.
So are you, what is your rate?
Right now, my rate is 3.375. Again, I'm 1 year into 10 years, so I still have another 9 more years to go of that. And I did that because my age is such that I'm like, well, I'm not planning on selling my house, but who knows? 10 years from now, I'll be in my 70s, and maybe I will want to do that. And so, why pay a higher rate? But I'm trying to decide if there's a big enough delta in rates that makes sense for me to do a refinance into a fixed product. I don't know if I want to go 30 years or 20, but that's really my interest.
Okay, so just me making an assumption that that everything is the way it should be. What I would do would be I would take a rate where I could generate enough credit to pay for all of your costs, so that you have literally a zero cost refi, and the rate will be better than what you have now. It's not going to give you a ton of savings per se, but it'll get you out of the ARM into a fixed product, and it would have zero cost for you. Wouldn't cost you anything to do it. Now, if we went to a 20-year or a 15-year, then we would be able to get a substantially lower rate. But if you wanted a 30-year fix to avoid worrying about things, then we could do a 30-year with no costs. And there would be no reason not to do that. If we went to a 20 or a 15, then you would see a benefit in the rate as well.
When you say no cost, you mean about just rolling all the closing costs into the principal?
No, I mean as in like us giving you a lender credit to pay for the costs, so that you're not absorbing any of them at all.
Okay.
You just bought a refi a year ago, right?
Correct.
Yeah, so you're not going to want to pay costs again. So we could strategically structure your loan to where you have zero closing costs, and it makes sense for you to do it just because it's costing you nothing to do it.
Okay, well, that's always good news.
Yeah.
Great. Well, Brett, we have a few more questions.
Sure.
JD, thanks for your questions. First off, when is a loan categorized as jumbo in the New Jersey Princeton area? Like the loan is beyond what amount?
This is a great question. It varies by the county you live in and the state that you live in. But to answer this question on a global stage, it goes by your county. In all of the United States, the non-jumbo cutoff is $548,000. In some counties, they're called high-cost counties, where the average income is above a certain level. They have labeled these counties as high-balance counties, and you can actually go up to $833,000 without it being a jumbo. So all of Pennsylvania falls under that 548. So Mercer, to be specific, is 548. But if you traveled up to Monmouth, a county up from Mercer, you're at that 820 or 830,000 level. So in Mercer, the highest you can go is 548, 250 before you reach the jumbo, and then you're needing jumbo services. I see another one in here. Do I help with loans for first-time home buyers? Of course. Our goal is to do way more pertinently. Last year was a refi boom. This year, I think, is still going to be a refi boom, but our goal is to make those relationships with realtors and through this Affinity program to do all of the purchases as well. We would absolutely love to work with first-time home buyers. I'm an expert in all of the products and programs that are available for first-time home buyers. So I would absolutely love to talk to you if that's the case. Thank you for the question.
All right, thank you, Brett. Are there any other questions?
If I could, going back to jumbos, what's typically the spread of a jumbo over a conventional for the same term?
So, I just priced one out yesterday, and right now it's like a 0.5 point in interest rate higher on the jumbos.
Okay.
So it's worth it to get it out of jumbo territory if you can. If you're close, put that extra money down. Obviously, if it's, several $1 million loan, it's easier to say. It's not so easy to just throw an extra 800,000 down. But if you're close, like I would not do a loan for 580,000. I would find a way to get it down to that 548 number just to avoid the jumbo territory.
And is it ever possible to readjust your term or rate with your existing lender so it's not considered a new loan, or is that just, frankly, I just get irritated paying that title insurance fee every time I do a refinance.
Well, that's why I was suggesting that we cover those costs for you. Doing that. And that's what I would, I would not pay it either. In fact, I don't. I always pick an interest rate where I'm able to get a lender credit from my lender to cover the closing costs, which are inclusive of the title fees as well. That's just the way that I personally go about it. When I shop, I'm looking for the best overall picture. I'm not looking for necessarily the absolute lowest rate. I'll take a good but slightly higher rate to be able to get a lender credit to pay for those fees, because if we paid for your closing costs and your title fees, then there's no reason to not refinance ever, because we're literally we're not raising your principal balance a single dollar. So that's what I would look to do for you or for anyone else first.
All right, and one more from Jay. How much time should we have for a comfortable closing? Is 60 days about right?
Well, sure. It's really going to depend on right now when the seller wants to leave their house. I mean, I'm going to bite my tongue saying this, but we're currently running 24 hours in underwriting. It's part of our goal to have this effortless experience for you guys. Loans are closing in well under 30 days, well under 3 weeks even. 60 days would be more than plenty. If it's a refi, I would say under 30 days. If it's a purchase, right around 30 days.
All right,
Absolutely.
thank you.
You guys are welcome.
All right.
Any more coming through, Isabel?
I think that's it, unless anyone has any further questions. And again, we will send this deck just so you can reference back any of the materials we covered, as well as the recorded webinar. And then I can also resend your specific application links that you have already set up with the companies you're associated with. And then aside from that, please reach out to Brad or myself if you have any questions, and we hope to hear from you again.
Hey, just a quick question, Brett. So are you
Yep.
purely a broker, or do you carry any of these mortgages you underwrite on your own balance sheet and then resell?
No, we're not a broker at all. We are a mortgage bankers, and the answer is both. So we could service if we needed to, but no company is really allowed to service more than 20% of what they originate. So you probably have found, and you're going to find that almost anywhere you go, that loan's going to wind up getting sold to some kind of sub-servicer. And that's true with anybody. Nobody's really allowed to hold on to 100% of what they originate. It's usually capped off at 20%. So you're going to find that no matter who you go with, you're going to get placed with a servicing company. But we are a banker. When we close, you're only going to work with Princeton Mortgage. You're going to get funded by Princeton Mortgage money at the closing table. There's no brokers involved, no third party, anything involved.
Okay.
All right. Well, if that is it for today, Brett, do you have any?
That was Albert. Any others, Albert? If you have anything else, I'd be glad to answer.
No, not right now. I'll probably ping you. I'll give you my stats and you can see if there's anything you can do for me. As I say,
Sure.
I just refinanced, 14 months ago. So it's like, well, is it even possible that I'm going to save anything here? And my only interest is, because rates are so low, should I be locking in longer than just the 10 years that I'm kind of fixed with this 10-year arm?
I think so. I mean, let's talk about it, but I think so. I'm not seeing a reason. I can't think of a reason why not to. So,
All right.
give me a ping, and I'd love to put it together for you.
All right. Thank you.
Oh, you're welcome, Isabel. I think we're good.
All right. Well, thank you all again very much. And of course, reach out with any questions. And again, you'll be hearing from me soon with this Brett's contact information. And if you're interested in applying, we'd love to help you out. And I hope everyone has a great rest of their week.
Thank you, guys.
Bye, everyone.
Thank you.
Bye.